Hi, I'm Bill Blain, strategist with Shard Capital. Normally based up in London, but today still working from home down in Hamble. Over the past few weeks, we've seen enormous change, a roller coaster in global markets. Back in March, as it became apparent just how dangerous the coronavirus was, we saw a massive crash as companies and investors around the globe expected economic mayhem. Since then, we've seen a rather surprisingly strong recovery in global markets. Stocks are back into a boom phase. You could almost say the bull rally has renewed. Many people remain very skeptical because there is enormous disconnect apparent between the rising stock markets and buoyant bond markets against the widespread expectation that we're still going to see a global recession. But the one thing we can say is it does look like we reached peak coronavirus first wave. All around the world, we're talking about reopening on a staged basis the global economy. It's happening everywhere, and that is a cause to be positive. The second factor that is driving the markets, and possibly the more important one, has been what I like to term QE infinity. Now, we'll all remember QE was one of the solutions adopted after the global financial crisis in 2008. It basically meant governments went in and bought bonds. The idea was that by buying bonds from investors, money would be freed up to circulate around the real economy. Well, very quickly we learned that money doesn't actually move from financial assets into the real economy. Most of the money that was raised, created through quantitative easing, simply ended up being funneled back in to more financial assets. And that drove buying across all financial asset markets. Although central banks were only buying bonds, the effect ultimately was to push up global stock markets. And one of the reasons for that is that companies were able to borrow money very cheaply because interest rates fell because of QE, and then buy their own stock back through buyback programs. Well, we all know where that led us to. But one of the key factors that I've always said about markets is in bond markets there is absolute truth. And that's certainly very true today. A few weeks ago, at the height of the crisis, all around the planet, every single major corporate was scrambling to raise as much money as they possibly could, assuming that the global economy was going to be in lockdown for months, if not years. Corporates drew down all their bank lending facilities and scrambled to shutter production to save money. Government very quickly stepped in with programs to make sure that corporates would have access to liquidity, and especially to make sure that small to middle-sized enterprises, SMEs as we call them, would be able to weather the crisis, announcing massive lending packages across Europe, the UK, and the US. Well, very quickly, some of these packages were arbitraged by corporates. It was quite disgusting to watch how some American big food companies tried to argue that because they were franchises, they were actually SMEs. And very quickly, the money that was allocated to rescue SMEs was troughed by some of the biggest companies in the country. It ended up with a second package very quickly being put in place to rescue SMEs. But the real thing that has changed sentiment completely in the bond markets, and therefore spread across all markets, has been QE infinity. And this is where the central banks are buying every kind of debt, everything from sovereign debt in Europe all the way down to junk and junk ETFs. The result has been one of the most enormous binges of debt we've ever seen. Somewhere in the region of 450 billion has been raised in the corporate credit markets since March. And much of that has been from companies poised right at the edge of default or being downgraded into junk. Now that has completely changed the composition of markets. It means that these companies are no longer so vulnerable to collapse as a result of a long-term slowdown caused by coronavirus, but it also means they can start thinking about how they're going to work their way out when economies recover. And the effect is a definite knock-on, giving confidence to the stock markets. As I say, in bonds there lie truths. In bonds, you will find the reason for the rising stock market. But let's think about what that means long term. For the last 8 years, companies around the world have benefited substantially from ultra-low interest rates. They've been able to finance themselves very, very effectively, and much of that money, as I said earlier, has gone into stock buybacks. That's not an efficient way to grow the global economy. It certainly pushes up the value of a company's stock and means that the C-suite directors get much bigger bonuses because the stock's gone up, not because they're selling more goods to global consumers. In fact, as we've seen income inequality rise with executive and managers getting paid more and more, we've seen the general salary and wages of workers falling in real terms. That's been a trend, and it's likely to continue where we're going next, because there's nothing to stop companies continuing to pay themselves. Just pick up a copy of the paper this morning and you'll read about how US companies have been shuttering their factories, putting their workers onto furlough pay rates, but yet paying the managers and directors higher salaries and even bonuses in some instances for the clever way in which they've handled the coronavirus. But moving on, let me give you an example of where this goes, what the consequences are going to be. And I'd like to illustrate that with taking two very different companies. Boeing is a company that many of you will heard me say I think is one of the worst examples of what can go wrong. Over the last 8 years, they've spent somewhere like $43 billion buying back their own stock. They've also borrowed most of that money from the markets. They haven't developed new aircraft. The result is that Boeing is massively indebted. It needs to raise more money, and the chances of it actually developing the new aircraft it needs to compete in the duopoly that is global aviation is very limited. They're going to have to borrow some $12 billion this year simply to keep their head above water. They need $25 billion to think about developing a successor to the absolutely discredited Boeing 737 MAX. In contrast, you have Apple. Now, I know many people don't like Apple. They think it's overpriced, but the fact is that Apple does know what its market wants, and that's what they sell them. And Apple also has an enormous war chest of cash on hand. Even if the global economy goes into a massive depression, Apple is going to be able to weather that storm based on the cash in its pocket. And therein lies the problem for many corporates. As the global economy starts to recover, and it's very likely and possible we'll start to see inflation, we're going to have many companies who have spent the last 2 months borrowing as much as they can from the markets through government loans and the bond markets, massively more leveraged. They have to pay these loans back. But how are they going to do that in a global economy in recession? How are they going to do that if interest rates rise because of inflation? And that's when you suddenly realize, well, maybe the corporate bond markets aren't such a great place to be invested. After all, returns are tightening very quickly again. Most global sovereign bonds like treasuries and gilts are pretty much approaching zero yields. In Germany, they're still massively negative. We even had the situation before the crash where we had junk bonds at close to negative yields. We're heading back there, and there's no point in holding negative yields if you're looking for returns. So you would probably want your money to work harder. Why don't you take it to the stock market? Oh, but hang on. The global stock market comprises mostly these very same companies like Boeing who failed to get it right over the last few years. These same companies who are highly over-levered are going to struggle to survive in a new global economy. And it's worth remembering that the global stock market is an awful smaller thing than the global bond markets, which means for every penny that comes out of bonds, it's magnified on its effect on the global stock markets. So what does that leave investors to do? If you're scared about the global economy, gold is one answer. The other is to be positive about the chances of growth, and that's why I think that SMEs, the smaller sector of more aggressive companies who are just at the beginning of their life cycle, are far more interesting. Much as I hate to say it, private equity might make a lot of sense, but so do other forms of alternative assets, investing in real assets, companies that actually make things and being secured on them and do them well. Whatever happens, the next few months is going to be extremely interesting. Thank you very much.